Hi everyone, it's Grant Abbott speaking, and welcome to this session for high income earners, the poor, lost, lonely souls of the Australian taxpayer. No Div 7A for these guys, and no deemed dividends or franking credits pumped through their company or streaming thank you to Bamford. Unfortunately, there's a lot of them who earn good bonuses from selling this and that, or just on high wages and salary. You can see up at the big end of town, obviously they get a lot of options, etc., to get some deferral. But for a lot of our clients, the size of their tax bills are quite significant. And when you have a look at across the family perspective, it can be very significant indeed. And unfortunately, they don't get a huge amount of relief. The government keeps on knocking it out as much as possible. So just my little thing, when I started my early years, I did tax law at the University of Sydney and then worked at the Tax Institute of Australia as the research director and got paid pretty well, not fantastically. And then did a Masters of Law while I was doing Masters of Law, then worked at Touche Ross and then ended up at KPMG. And then ultimately Rothschild. So I know the pain and the horror for the high income earner, that when they see their group certificate or the certificates at the end of the year, how much tax is actually paid. And the worst thing about it is it's actually paid on the way through the system, so through pay as you go. It's very difficult to get out of until, of course, you get retired. And if you're just living off your superannuation money, if you're lucky enough to have a self-managed super fund, you're out of PAYG, out of income tax altogether, which is the ultimate. So, but still, you pay your dues for that period of time. Look, now and then we're very lucky, blessed. They're usually short windows and they're open pretty quickly. And then once people work out how they can be used, they're closed down. One of the big ones was, I'm sure some of you remember, put your hand up if you can remember, the infrastructure bonds way back in the mid-1990s. I remember doing sessions on them, but they were great little offers. And I see Steve Lee, of course, you would have known it, Leggy, of course. But Macquarie Bank actually did $1 billion in the Melbourne toll roads in the space of around about a year and a half. And it was bizarre because you could effectively leverage someone on like a $90,000 income could have $1 million or a couple $1 million loan for these infrastructure bonds. So the government gave some great tax incentives at that time, and they were really kept few and far between. So to get the good ones, you had to be on the inside running. Of course, everyone at Macquarie Bank was at that time. The place for millionaires. Obviously, agricultural came in the mid-2000s and earlier before that, where there'd be, you'd buy a pine lot or something. Great Southern was the big one, Timber Corp. You'd buy a pine lot somewhere and there'd be tax deductions and management fees, and, you'd write off and under the understanding that in 15 years' time that would return and you'd have all these pine trees that everyone wanted and that stuff. And I remember going for that. I've got Darren, so the volume's going in and out of that end. So just keep up with me, the other guys. As I said, I'll try and keep it a bit closer to the microphone, so hopefully that is a bit better for you. And but if you remember the agricultural schemes, they sort of went, the Commissioner started to attack them, and there was obviously huge amounts of inquiries, etc., around that. But there's still some great tax and super strategies out there, and I'm going to show you a few today that will really have an impact on high income earners. Of course, the strategies that we're going to look at today work just as well for small to medium enterprises that have significant cash flow. But at the end of the day, I'm looking at I'm making sure that I look at your high income, the people who are the hardest. So then we can also peel it back. So I've got a little family one at the end, which will be really good. So each one's actually going to depend on the client's circumstances and, more importantly, the cash flow. Remember, most of these people are on PAYG. So this one came to me from Gordon Black, surreptitiously. So It's an amended sort of version of my good friend Gordon Black down in Melbourne, who deals a lot with some very erudite clients. And we've got a Jim Jones who's 35 years old, earns $400,000 per annum, and a successful computer consultant with limited ability to shift income. He's a sole trader, and with his business humming along, Jim's tax liabilities are significant. On $400,000 of income, the ATO simple tax calculator shows that you pay tax of $153,097. Now, I've just used, sorry about that, but you'll see in the case study, I've just used the simple income tax calculator, not to get it down to exact dollar, because I'm sure you guys would do it differently, but it's to get the thematic right. So as long as I'm using consistent base to make a tax determination, then all the best. Jim's also got he's a sole member of the Jones SMSF with $300,000 in his superannuation benefits sitting in cash because he's been claiming tax deductible contributions. So for a 35-year-old, that's pretty typical. You know, you probably see someone who's got that sort of income. They might have like a couple of negatively geared properties and also, you know, a couple other minor things, but it's really few and far between. Certainly, we would be very, very reticent about telling him to make huge amounts of superannuation contributions for the reason that those monies going in generally, and I'm talking generally now because I'm going to flip you out in a second, generally are preserved monies and they're left in the system. So for a 35-year-old, let's face it, by the time he's aged, you know, he probably won't have access to his super until he's aged 65 or 70. So it's a long way down the track. And really, it's not going to help his underlying cash flow needs we've got there. And when I go through, these sort of strategies are good for fly in, fly out. Computer consultants is also good for, obviously, doctors, professionals, anyone who's radiologists. You know, I've seen some of those guys earning $1.2 million. So we'll go through and have a look at how they can play out. So the key for it is, for me, is this one section. So I've actually extrapolated or pulled the section straight out of the legislation. So this is the Income Tax Assessment Act 1997. And we'll just go through this and talk about the ins and outs. And it talks about excess concessional. So it says there is a cap on the amount of superannuation contributions that may receive concessional tax treatment for an individual in a financial year. So if we have a look at Jim Jones as a sole trader, as an individual, he can make a personal tax deductible contribution under Section 290 of the Income Tax Assessment Act. And at that time, there is no limit on the amount of deduction. The way the deduction is curved is via Section 291(1). So we've got a limit, a cap on the amount of super contribution may receive concessional. Now, you can carry forward the unused concessional cap from previous 5 years, but that doesn't start till this year. So, and up to the super balance of 500, which is, that's okay, that's a nice to know, but we've got to get a bit further into the system in order to access that. This one is the key. Actually, the next few sentences are really the guts of the strategy. Superannuation contributions that exceed your concessional contributions cap are included in your assessable income for the corresponding income year. So previously, we know that the caps ridiculously, I don't know about you, but I just think it's absolutely ridiculous, are $25,000 for everyone at this current point in time, except if you're obviously over age 75, you can't make any contributions. Anyone under that, 65 to 75, obviously you've got to be working for 40 hours over a 30-day period in the year. But under that, anyone can make a super contribution. And as I said, at the moment, you can have both your employer and also an individual making a personal tax deductible contribution, which is classified as a concessional contribution. So if I put in $50,000 this year, then in simple terms, if I read this, my cap is 25. I've exceeded my cap by 25. So that is going to be added back to my assessable income for the current year. So if I put in 50 now, and I already know that that's coming back, then it's going to come back as assessable. But what's happened is by putting that 50 in now, obviously I've reduced my tax liability in the current income year, which is crucial. So that has an immediate impact on my total tax liability. But remember, I'm going to have to add it back. The nice one that I like is a tax offset, which is equal to 15%, compensates for the tax that generally applies at contributions in the superannuation fund. So that's the big, that's the big draw card for us. And I'll work through that a little bit later on. Now, there's a little bit of difference, and I love to see it. In fact, I was looking at CBUS the other day, and I was going through their different investment options, just to, because you can start to see now the industry funds are comparing themselves to SMSFs, and blow me down. CBUS has got a growth option, which you can choose, and that's mainly in Australian equities and international equities, but they've also got a self-managed option. So a self-managed option, which is a bit like a wrap account, you can choose your own investments, but they're getting a bit scurrilous there, if you ask me. It certainly doesn't seem to me to be an issue in terms of the superannuation fund, calling it self-managed. So then we go down to the next one. So there's a 15% tax offset. Part 235 in Schedule 1 to the Tax Admin Act, which I'll talk about, contains rules about a charge you might be liable to pay. So that's the excess concessional contributions charge, which is around about 6% based on the tax liability or the added back tax liability for the period of time from day one in the income year when you make that excess contribution up to when you receive your amended assessment. Because essentially what happens is you'll put in your assessment with the lower amount, that will then raise an assessment. Then the commissioner receives your personal income tax return and also receives the return from the superannuation fund to determine the amount of excess concessional contributions, and then we'll raise an amended assessment. And in the instance we talked about before, the amended assessment will be based on $25,000 plus, obviously then there'll be a tax offset of 15%. So an excess concessional charge will be there. But the Tax Administration Act also talks about releasing the excess concessional contributions from super. So when we have a look at that, the way it works, and I might go into Jim Jones and we'll talk about it, but effectively we do have an ability to release 85% of our excess concessional. So prima facie, they're not preserved, they're more in abeyance as preserved contributions until a certain period of time after the amended assessment. But let's go and have a look at Jim Jones. Remember, we've got, if I have a look at the Supermax strategy flow, I've got the employer there contributing into an SMSF. Ideally for Jim Jones, makes a big difference. The problem with the strategy is essentially if it goes into an Australian super or someone else who takes a 15% up front, really it doesn't work to any great extent because there's a timing and you can't really make a permanent tax difference. If it goes into a self-managed super fund, all of the deductible contribution or concessional contributions included in the fund's assessable income, which we're going to work on very shortly. So we've got Jim is 35. He's got $400,000 of income. We're going to contribute over the cap for Jim. And the way it works is that at the time of amended assessment, Jim can go to the Commissioner of Taxation and either pay or get the Commissioner to take that amended tax assessment amount out of his superannuation fund by way of a release authority, or can actually take 85% of the excess amount, and I'll look at that in a second, by way of a release authority. And of course, we need to look at the tax impacts and, more importantly, the contributions tax. So let's have a look at Jim. He's on 400, but we're going to a concessional contribution of 125. So as we said before, the tax on the 400 was 153,097. Again, it's probably inaccurate because it's using the simple tax calculator. But by reducing it down to $125,000, so that his taxable income is now $275,000, it's been reduced to $96,847. Now, it'd be great if that was it, but remember, we have to add things back. So the 100,000, not the 125, because it's only the excess concessional contributions which is added back. So the $100,000 excess is added back to Jim's assessable income as an amended assessment using his marginal tax rates from the lift-off point of where he is, so using the marginal tax rates there, less a 15% tax offset, which is what we said to do. So thank you very much, Tim Munro, great supporter of the Lightyear Group, and I'm a great supporter of Tim. Hopefully going to see you guys at the 2nd of September at Tim, where I'll be going through this in a lot more detail. But Tim's got some great tax calculators to do the forecasting, which I know he's building in the Supermax strategy. So we'll be releasing on the day. So we added back the $100,000. We find that the extra tax is $37,750, and that includes the excess concessional contributions charge of around about $2,000. Remember, that's 6% on what the tax liability is, plus the sustainable superannuation charge. That's Section 293 of the Income Tax Assessment Act, and we're probably well aware that when someone's low tax contributions, which is the $25,000 plus their assessable income, exceeds $250,000, then there is an additional 15% contributions tax added in this case, which I have done. But the 15% never applies to excess concessional, only applies to that 25%, which is what they call the low rate charge. So when we have a look at that, the extra tax is $37,750, which includes the sustainable super. Now, that means we've gone from $153 to $134,597. But there are a couple of benefits and a couple of ifs and buts around that. Of course, we have to monitor, and again, I think it'd be great to use Tim's calculator, the actual tax impacts on it, and more importantly, the cash flow impacts of it. So on salary, Jim's up for SGC, contributions tax, and also sustainable tax. So he's going to be up for it anyway. So we've just simply added to it and gone above that. And I'm going to go a lot further above that a little bit later on. One of the benefits there is in super, his assets are actually protected from his creditors. So that is an advantage. Now, the money release, remember we had a look at that a couple of slides ago. Down the bottom there, if we have a look, Part 235 of the Tax Administration, I haven't brought that in, but you can go through it, talks about releasing the excess concessional contribution from the superannuation. What that says is, in essence, that he'll be able to release 80 or up to 85%. And what happens is, unlike a non-concessional where you go to the trustee to release the money if it's in excess, where it's excess concessional, you have to go to the tax office to get the specific release amount. So you'll be able to go to the commissioner and just say, well, hold on, I want to release the 30, what do we have the day before? We could say here we want to release $37,750, just take it out of our superannuation fund and so be it. Now, ordinarily for someone over maybe 55, 60, that's a good idea because you want to keep the money inside the fund. But when you're dealing with a 35-year-old who needs cash flow, what we want to do is wash it out. So what we can do is we can go to the commissioner and say, look, of the 100 that's gone in, we want $85,000 out. And of that, we can then use that to pay the $37,750, and then we're going to pocket the other $48,000. So we've got that. It's quite strange that $85,000 from the time we make the contribution until about 60 days after the amended assessment issued by the Commissioner, wherein it's almost like a preservation suspense account, so to speak. So rather than being preserved monies, that money needs to be set aside, because if they don't make that release authority, then effectively it is all preserved. So poor old Jim has got that money stuck forever. But here we've got that flexibility, and to me, out of this strategy, this is the big wash up, is the ability to put the money in and then find that money coming out, or the 15% out. Now, this is the key. I'm going to see this a little bit later on. Is we need to minimise the contributions tax, because effectively we should add that into the strategy, and if we don't minimise that, then effectively the strategy doesn't stand up. But if we set in place a plan to effectively minimise, and I've got 3 suggestions here. If we set in place a plan to minimise that contributions tax, and this might happen, we might have parents in the fund who already have got plenty of imputation credits, because we're looking at minimising 18,750. If we can do that, that's when we're actually making a real difference. So I've just done a rough estimate, and I'm sure Tim would probably be able to pick this up a lot quicker. But just on a 6% interest, then we'd need a $1.66 million loan to give me an interest deduction of $100,000, which would wipe out the tax liability. But obviously, Jim's not in that because he hasn't got $1.6 million. $1 million share portfolio, fully franked dividends, will give me $18,750 in franking credits. Will wipe out my contributions tax. Perhaps Jim could use instalment warrants where he's getting interest deductions and franking credits as well for that, but might not be the cycle to do that at the moment. I know Tim uses protected equity loans, so again, that's a good suggestion there. One of my favourite ones is the early stage innovation companies. Effectively, this is probably the best I've seen in sort of tax incentives, probably in the last 20 or 30 years, because you're actually getting getting a 20% tax offset for any monies invested in. So even if you put in like $10,000, you're going to get a $2,000 tax offset. But to put $100,000 in, if Jim does and he's got that spare cash, then effectively he'll get a $20,000 tax offset, which will then parlay into that getting rid of the contributions tax. Plus, in fact, he could probably go above that amount of contributions in order to absorb all of the tax offsets. So, look, it's to me, it's one of the great strategies I've seen. So let's go a little bit further. One of the things is that where we have an excess concessional, as I said before, it's also treated as a non-concessional contribution, which means we have to bear in mind, and it's good for someone like Jim. He's very young, so he's still got plenty of caps around, but we need to bear in mind where we are with the caps. So if I put in $325,000, I can use the 3-year bring forward rule. Now, that would mean that if I wanted to replay this next year, then effectively I can still do it, but it means I'm going to have to pull out the non-concessional amount, which isn't a bad thing. I mean, you've got the full release of it anyway, but there's just a little bit more of a charge on it. So what I'm doing now is I'm going 300,000. I've got the 3-year bring forward. So I've dropped my tax liability from 153,097 down to 15,992. Now, why is that the case? Well, it's because we've got Jim in a position of not getting $400,000, but going down to only $75,000, hence the low tax rate there. Now, mind you, Jim needs money to live on, obviously. So if you're bringing this around on a year-by-year basis, then it can work out. But also, this is perfect. I know, for example, for example, Gordon, where a client gets a large bonus and that's all taxable, if we've got that cash bonus, this might be a perfect place in which to invest that inside our superannuation fund. So we then go back and we've got the $300,000 excess is added back to Jim's assessable income as an amended assessment using marginal tax rates less than 15% offset. So the extra tax is 84,425, and that includes the ECC and the sustainable. So again, we've dropped down $50,000 or $53,000 there. But mind you, we've got $325,000 sitting inside. We've got $325,000 sitting inside our super fund is subject to contributions tax. So we're going to have to make sure we've got lots of interest deductions, franking credits, or that's where the ESSEC stands. So at some point in time, we're going to have to look at the whole thing and work out where it's best for us. With the $300,000, let's see if you're with me here. That excess amount, what amount can he pull out from the superannuation fund by way of after the amended assessment? So you can actually ask the Commissioner of Taxation to release. I'm just trying to get my calculator. I should be able to do this straight off the top of my head. So if I have a look at clear, so you can actually take out $255,000 back out of the system. So if you are using this system and you want to get the release, there seems to me to be a couple of things, and I'll just talk to it now, is if you want to play this out, the time to make the contribution into super effectively is at 30 June. So we want to make that tax deductible. Look, I've got 325, it could be 125, it could be even just for your smaller client. Actually works, you'll see very shortly, a lot better for smaller clients because of the 15% offset. It could be that, you know, you're waiting and you're putting that money in. Now, knowing really effectively, if you wanted to, if you get all the tax returns in very shortly, and remember this has to be the super return plus the individual's personal income tax returns. If you lodge that, then once you get that amended assessment back from the Commissioner, you then actually get access to that money very quickly. As we said here, it could be 255. But the problem is about putting, if we wanted to put 125 in on 30 June, I've then got a problem that that money is sitting in there effectively for that perspective. I've got a problem that I can't get any tax relief unless I do it on that day, unless I've got really franking credits and interest is going to be impossible unless I've got a big loan. So someone like Jim is in a perfect scenario whereby he's already got money sitting in his SMSF. So that could be used to either look for franking credits, go into installment warrants, go into other products, or more importantly, invest in a range of ESSECs or early stage innovation companies to get that credit up and running, knowing that you've got plenty of capacity coming down the track there. So that's the way that I would play that strategy out personally. Now, another aside here is we've talked, and I'll come back to Jim being the sole trader, but if he's able to set up a computer consulting company or family trust, bearing in mind personal services income, if he's just looking for one client, then that's harder. If he's got a number of clients, then he should be okay. Then if we've got here, Jim's father, Jim Jones Sr., is 65 and he's retired. So contributions can be made on behalf of Jim. He's living off his tax-exempt pension income. You can see there he's over in the old Dart having a good time with the missus. We contribute over the cap, and then we can have a look at the cash flow impact for Jim Jr.'s family if I have a look at the next one. So what I'm doing there is, what I want to do there is the family trust switcheroo. So if it's possible, so the first strategy was obviously to use the ability to put excess concessional in and pulling it out. The second one is obviously now using other family members if we have got that capacity. So Chengor has the Div 293 tax being taken into account? Yes, to work out the tax saving. So I'll send you through all the case study after this. If you've been registered for it, I'll send you through all the works through, and then if you've got any questions, obviously come back to me because I've done the numbers. Bear in mind, Chen, that I've used the dodgy old income tax calculator from the commissioner. So, and that was based on, unfortunately, the simple tax calculator 2018, 2019. So there's probably an overassessment there. But again, it's the philosophy. So what we're doing here is Jim Jones, if he's got a family trust or company, effectively he's employing his father to do office work. Now, it could be just 10 hours a month or, whatever. So we've actually got Jim and perhaps his good wife or Jim Jones Jr.'s mum. They could both be working. Now, if we have a look at Ryan's case, and there's also an ATO ruling, I think it's 2008/5, which basically says that, particularly for this one, it's a great one, a computer consultant employs their spouse as a administrative assistant. They don't do much work, but they make a contribution of, I think it was $110,000 on their behalf, while the consultant virtually took next to nothing out of paid next to nothing in terms of super. The commissioner held that, as far as that, wasn't a deemed dividend, even though it came from company, and more importantly, tax avoidance did not apply in that regard. So what we do is we go through the same process as we did before, and $75,000 is full salary sacrifice, so he's not getting any cash. Remember, he's living on tax-exempt income anyway, and then have a look at going through the $50,000 excess is added back to Jim's assessable income as amended assessment. So when we do that, we find the extra tax with ECC is $495, but really, if you have a look at LITO or low income tax offset and low to middle income tax offset, effectively there won't be any tax. So the best strategy of all is if you can get your parents or alternatively retirees into that family unit, and they can generally work, and you want to do an employment agreement, from that perspective, what we need to do is we can utilise their resources. And it's also beneficial because Jim Jones, depending that, obviously hasn't breached his T-bar, that effectively we're in a situation that we can use their capacity. More importantly for Jim, you can also basically get the difference. So I've got a question here again from Liam, that the excess concessional contribution. Okay, so given the franking credits are refundable, again, it's going to depend on whether it's interest costs, Liam, to get the essentially inside the fund. Again, you're quite right. If there was a father in there and you're using their franking credits, then you're in a pretty bad position. But for someone like, if we have a look at Jim Jr., he's just not going to be able to get the franking credits in there anyway. So probably his best bet is going to be going to the next one, which we'll have a look at. For that, we talked about the strategy flow for employment. Another one is, look, I go through the superannuation one. Look, it's just as easy for potentially Jim in this instance to look at ESSEC. In terms of ESSEC, as I said, it's available to a number of companies. You can be around for up to 3 years. So generally, it's got to be a new business, service, or product development with worldwide application. So, for example, we're currently in a position of being an ESSEC company. So, Lightyear Group we haven't earned more than $200,000 of income. We've got contracts and tenders for our strategy automation software overseas. So we fit right into that point of view in terms of ESSEC. But, again, there's a lot of ESSECs out there if you want to go down that track. So you get a 20% tax offset, and because Jim be a sophisticated investor, he can invest up to $1 million in a range of them and get a $200,000 tax saving. So, but the main thing there is also if it's sold within 10-year period or go to IPO, there's no capital gains tax. So for Jim, it's not a bad idea to have a look at just ESSEC itself, or ESSEC combined inside the super versus ESSEC outside. And more importantly, you know, as Leanne pointed out, is if we've got franking credits inside the fund, if they're our parents, we can utilise them. But again, there needs to be a tax offset there when we have a look at the total amount. But we'll send through all the papers there. So if we have a look at it there, we've gone through the various strategies. Oh, sorry about the typo, Unitil now. So for us anyway, look, and I'm more than happy to go into any dialogue and have a chat with you guys about quite a wide range of strategies, but we need to cover stuff both in and out of the box. For me, the best one obviously is going to be where we've got the family trust switcheroo. That's the best, where we can bring other members of the family in and either employ them or distribute to them, and they put contributions, deductible contributions on their behalf because they've got plenty of capacity. We've got someone young like Jim. Generally, we wouldn't be talking about super anyway unless I've got that superannuation access strategy there. But as I said before, you do need to work on that contributions tax inside the fund. Negative gearing has been used for such a long time, particularly the typical thing would be for Jim to jump into negative gearing. But look, my feeling is that for someone of his age, particularly in the computer environment, I would say that it's better to have a look at, obviously ESSEC that he's aware of. Now, mind you, ESSEC is probably too good to be true because it's 20% tax offset on the actual investment, not the underlying interest or management fees on the actual investment. At some point in time, that's probably like the original infrastructure bonds, it's going to blow out. But you can do it with the super or do whatever. As I said, we're going through a small capital raising, and if you want to get on board, we've got some capacity, but given the fact that, we are ESSEC now, that effectively someone like Jim could put $100,000 straight in and get a $20,000 tax offset, which makes quite a significant hit to his obviously tax bill throughout the year. But look, they're just a few of my ideas. As I said, there's not a huge amount. You can always use it's very difficult. If he's a computer consultant, obviously he's using his maximum deductible. Obviously, what is it, $30,000 now? You can get a deductible for all his computers, but there's only so many computers you can use. But at least this way, we're starting to eke out and make a little bit of difference in terms of the ability to get cash back and ameliorate for whether you're a doctor, radiologist, fly in or fly out. Anyway, I'll send this through to you along with the case study, and then we can work. And if you've got any questions, just send them to me at Grant at ilovesmsf.com. Or if you want to have a chat with Michael about like your group's ESSEC status and get an offer document, it's Michael at ilovesmsf.com. Anyway, thanks for attending. There'll be you'll get your CPD certificate and this recording and the case study within the next few hours. I just have to set up the recording. So thank you very much.